tariffs impacting your stock or a company's bottom line? At Fundamental Edge, we talk about understanding the impact of news flow to numbers in a framework called incrementalism. Here's how we would approach it. We're going to walk through the 5 steps of assessing tariff impact on a company and stock. We want to understand what's in COGS, the unmitigated EPS exposure, the offsets that may exist, triangulate what might be happening with real ground truth, and lastly, assess the expectations gap. Let's start with step 1, COGS decomposition. The first step in this process is to try to understand aggregate exposure and to decompose COGS into component buckets. Now, companies sometimes disclose revenues per geography, and we might use that mix to estimate a blended tariff rate. Sometimes companies also give hints about cost buckets in COGS. The output here is an estimate of what a step up in tariffs does on a per item basis. Once you have that chassis built, you can do some fine tuning and pencil out an impact. In step 2, we work out the unmitigated exposure. That is to say, what, for example, a 30% tariff would do to EPS by flowing gross margin compression down to EPS. We now have a worst case scenario without any offsets. In step 3, offsets analysis, we're going to look at what companies might do, what levers they might pull. We know that retailers will try to mitigate and offset that EPS impact, so we start looking at what they can do in practical terms. Maybe they share the burden of costs with suppliers and customers. Maybe the company embarks on a cost-cutting campaign. There could be freight rate relief due to lower competition for container shipments, and there could be FX movements that provide some relief as well. So there are some endogenous and exogenous impacts that could provide some mitigation. Now remember that pricing power isn't unlimited, so you'll have to evaluate as part of your analysis how the market could respond to a systemic shock. Pressure testing and fact-checking your assumptions on price elasticity will be key here. In step 4, triangulation and ground truth, we now have some hypothetical frameworks, and we can start talking to supply chain players, sell-side analysts, and competitors to try and triangulate the actual impact. Here's where you try to connect the dots between different players in the value chain to sensitize your upside, downside, and base case scenarios. In step 5, thinking about the outcome range and the expectations gap, you can use this analytical framework you've got to assess what's baked in, what you think is a likely central case, and how large of a gap there is between those. Now, it's not an exact answer, but it's a valuable framework to help guide your analysis as an investor and remain level-headed when big news hits. Interested in learning more about these types of in-depth analyses? Visit fundamentedge.com to explore Analyst Academy, where we break down complex concepts like these to help you become a more confident investor.